You open your brokerage app at 11 p.m., and there it is again. Your portfolio, up 4% this year while the S&P 500 sits at 11%. You didn't do anything wrong, at least not on purpose. You bought good companies. You read the headlines. You even sold that one stock right before it tanked, or so you thought, until you watched it rip 40% the following month without you in it. So you close the app, you tell yourself you'll figure it out tomorrow, and tomorrow you do the exact same thing that got you here in the first place. My name is Nick, and today we're going to talk about something the entire finance industry would rather you not think about too hard. Why most investors, and I mean the vast majority, will never beat the market. Not because they're unintelligent, not because they didn't try hard enough, but because of a set of behaviors so predictable that Wall Street has built entire business models around them. Let's start with the number that should make you uncomfortable, depending on which study you look at. Somewhere between 80% and 95% of actively managed funds underperform their benchmark index over a 15-year period. These are professional money managers, people with degrees from top universities, access to research teams, real-time data feeds, and every advantage you could imagine. And most of them still can't beat a boring index fund that just buys everything and does nothing. So if the professionals with all that firepower can't consistently win, what exactly makes the average person at home, trading on their phone during lunch breaks, think they're going to be the exception? The uncomfortable truth is that beating the market isn't primarily a knowledge problem. It's a behavior problem. And behavior is a lot harder to fix than knowledge. Here's where it gets interesting. Dalbar, a research firm that's been tracking this for decades, found that the average investor consistently earns significantly less than the very funds they're invested in. Not a small gap either. We're talking multiple percentage points per year, year after year, compounding into a difference of hundreds of thousands of dollars over a lifetime. Think about that for a second. You could put your money into an index fund that returns 10% annually, and somehow still walk away with an actual return closer to 6 or 7%. Same fund, same underlying investments, wildly different outcomes. How is that even possible? The fund didn't change. The market didn't change. You changed, or more specifically, your behavior changed at exactly the wrong moments. Let's talk about what that actually looks like in real life. Meet someone we'll call Marcus. Marcus opens an investment account with $10,000. He's done his research, he's excited, and he puts it all into a diversified index fund. For the first 6 months, things go great. The market's up, his account's up, and he feels like a genius. Then the market has a rough quarter. Nothing catastrophic, just a normal 12% pullback, the kind that happens every year or two, like clockwork. But Marcus has never actually watched his real money disappear on a screen before. Seeing $1,200 evaporate in a few weeks does something to his brain that no amount of reading about staying the course prepared him for. He starts checking his account every single day, then multiple times a day. He reads an article about an impending recession. He watches a video of someone confidently predicting further declines. And one evening, after watching his balance dip another 3%, he sells. Not because the fundamentals changed, not because he needed the cash. He sold because his nervous system couldn't tolerate the discomfort anymore. 3 weeks later, the market recovers. Then it keeps climbing. Marcus watches from the sidelines, now holding cash, waiting for a dip to buy back, and that never quite comes. Or when it finally does, it's smaller than he expects. And he hesitates again because now he's afraid of being wrong twice. This is the pattern. Not a one-time mistake, but a repeating cycle. Buy high with confidence. Panic during the inevitable dip. Sell low out of fear. Wait too long to re-enter. Buy back and later at a higher price than where he sold. Rinse and repeat for the next 20 years. Marcus isn't stupid. Marcus is human. And that's precisely the problem, because the market doesn't reward intelligence. It rewards discipline. And discipline is fighting against millions of years of evolutionary wiring that says loss and danger require immediate action. Let's get into the actual mechanics of why this keeps happening, because understanding the why is the only thing that gives you a shot at not repeating it. First, there's loss aversion. Behavioral economists have shown that the pain of losing money is psychologically about twice as intense as the pleasure of gaining the same amount. Losing $1,000 doesn't feel like the opposite of gaining $1,000. It feels dramatically worse. This means your brain is wired to overreact to downturns and underreact to the slow, boring gains that compound quietly in the background. Nobody feels euphoric watching their portfolio grow 0.03% on a Tuesday, but everybody feels a jolt of panic, watching it drop to percent before lunch. Then there's recency bias. Your brain assumes that whatever just happened is going to keep happening. If the market's been climbing for months, you feel invincible and pile in more money, often right near the top. If it's been falling, you assume it'll keep falling forever, and you sell right near the bottom. This is exactly backwards from what actually tends to happen, but it feels completely rational in the moment because your brain isn't built for statistical thinking. It's built for pattern recognition based on whatever's directly in front of it. Add to that confirmation bias. Once you've decided the market is crashing, you start noticing every headline that confirms it, and ignoring everything that doesn't. You watch the doom and gloom video, not the one showing a calm historical chart of every recession eventually ending. Your feed, algorithmically speaking, gives you more of exactly what you already believe, which means your fear gets validated instead of challenged, right at the moment you need a challenge the most. And then there's the one that really gets people, the illusion of control. Trading feels like doing something. Sitting still feels like doing nothing. So even when doing nothing is statistically the better choice, your brain craves action because action feels productive, even when it's actively destroying your returns. This is why people check stock prices obsessively, why they tinker with their portfolio every few weeks, why they can't resist just moving a little money around during volatile periods. It's not a strategy. It's an anxiety response disguised as a strategy. Now here's where the finance industry comes in, because none of this happens in a vacuum. Financial media has an entire business model built on urgency. Breaking market news doesn't get clicks. When the headline is, "Nothing significant happened today, stay invested," fear gets clicks. Excitement gets clicks. Certainty, even fake certainty, gets clicks. So you're bombarded daily with headlines engineered to trigger exactly the reactions that hurt you the most. Not because anyone's plotting against you specifically, but because outrage and fear are simply better business than patience and boredom. Brokerages benefit too. Every trade you make, whether through direct fees or through payment for order flow, generates revenue for somebody. An app that makes trading feel like a game, with confetti animations when you buy a stock, isn't designed to help you build wealth slowly and boringly over 30 years. It's designed to keep you engaged, and engagement means activity. And activity is usually the enemy of long-term returns. Nobody makes money off you doing nothing for a decade, even though doing nothing for a decade is frequently the single best financial decision available to you. Let's talk numbers again, because this is where it gets almost absurd. Studies have shown that missing just the 10 best trading days over a multi-decade period can cut your total returns roughly in half. Not the 10 worst days, the 10 best days. And here's the part that should genuinely unsettle you. Many of those best days occur within days or weeks of the worst days, during the exact periods of maximum fear, when panicked investors are busy selling everything. The people who sell during the crash are statistically very likely to also miss the sharp recovery that follows, because by the time it feels safe to get back in, the majority of the gain has already happened without them. This means the investors who beat the market over the long run usually aren't the ones with some secret system or superior stock-picking ability. They're the ones who simply didn't do anything. They kept contributing on autopilot. They didn't check their accounts during the crash. They didn't watch the news. They essentially forgot their money was invested at all, and that forgetting is precisely the superpower. Warren Buffett has said the stock market is a device for transferring money from the impatient to the patient. That's not a cute quote. That's a literal, mathematical description of what's happening every single day. So what does this mean for you practically? First, stop believing that beating the market requires finding the next hot stock, or perfectly timing your entries and exits. It doesn't. It requires the much less glamorous skill of doing almost nothing for a very long time, even when every instinct in your body is screaming at you to act. Second, understand that your emotions are not a reliable guide during volatility. The moment you feel the strongest urge to sell is statistically one of the worst possible times to actually do it, and the moment you feel the most euphoric and want to pile in more money, is often one of the worst times to do that too. Your gut feeling and the correct financial decision are frequently pointing in opposite directions, and no amount of intelligence exempts you from this. In fact, sometimes the smartest people are the most vulnerable, because they're confident enough in their own reasoning to justify decisions that are actually being driven by fear dressed up as logic. Third, automate everything you can. Set up automatic contributions so the decision to invest isn't something you have to consciously make and potentially talk yourself out of every single month. Remove yourself from the loop as much as possible, because every time a human being is required to make an active choice under emotional pressure, there's a real chance that choice gets made badly. Fourth, if you must check your portfolio, limit how often. Checking daily exposes you to far more short-term noise and volatility than checking quarterly or annually, and that noise is precisely what triggers the panic selling cycle in the first place. The people who check their retirement accounts once a year and the people who check daily are often invested in the exact same funds, yet the annual checkers consistently report less stress and fewer costly, emotionally driven mistakes. Here's the part that might be the hardest pill to swallow. You are, statistically speaking, probably not going to beat the market through skill. Almost nobody does consistently, including the professionals who dedicate their entire careers to trying. But here's the good news hiding inside that bad news. You don't need to beat the market to build real wealth. You just need to capture the market's return instead of sabotaging your own. The market historically returns somewhere around 7 to 10% annually over long periods. That is already an extraordinary result if you simply let it happen uninterrupted for 20 or 30 years. The entire game isn't outsmarting Wall Street. It's outlasting your own worst instincts. This is why the person quietly investing in a boring target date fund and never touching it often ends up wealthier than the person who spends hours every week researching stocks, reading forums, and trying to time every move perfectly. Not because the boring investor is smarter, because the boring investor removed themselves from the equation. They stopped being the variable that ruins the math. So if you take one thing away from this video, let it be this: the enemy of your investment returns was never really the market. It was never a recession, or inflation, or some geopolitical crisis you saw on the news. The enemy has been sitting in the driver's seat the entire time, checking the account balance at midnight, reading headlines engineered to provoke a reaction, and mistaking activity for progress. The market has been patient with all of us for over a century. The real question is whether you can finally be patient back.